Hi, it's Grant Abbott from Tax Guru and so Lightyear Docs. Talking about capital gains tax now. In the history, prior to 1985, when our first ever capital gains tax was introduced, capital gains, or essentially gains that were made on property shares that were held for longer than 12 months, essentially were capital gains tax free, which was fantastic. Wouldn't that be great now? They introduced in 1985 capital gains, but only net capital gains were to be introduced. So you have your cost base, and then it will be indexed for inflation, and then the any net gain would then be included in your assessable income and tax your marginal tax rate. In 1999, the Howard Costello government decided to do away with that, and mainly to help in terms of record keeping, to offer a generous, which I think was very generous at the time, a 50% discount. So from 1999 up until the present point in time, that 50% discount has really made a difference. So on a top marginal tax rate of 45% plus 2% NDIS and Medicare levy, we effectively had now, if you sold a property and you made a gain, only 50% of the gain would be included in your assessable income. If you're in a trust, that could be distributed or streamed amongst all the beneficiaries over 18s or into a company. So it's quite beneficial in terms of that. What we're looking now is, the word out is that maybe that capital gains tax discount will be reduced to 33. So if it's reduced to 33, it's like anything. If you have a look at the government's 293 tax, which was on superannuation, starts at 300, comes down to 250. So as soon as they start pulling the hammer on or the brakes on it, expect it to go further. But if it goes 33, some of the things you've got to watch out for is it 33% from that time onwards? So that means everyone holding assets between now and the May budget date, that suddenly there's going to be a 17% slippage. If that's the case, expect to be a lot of sales between now and also the 12th of May. The other one is they may have a transitional provision, which quite often they do. They might say it's 33% after such and such a date, enabling people to sell. But look, I don't know. If that has an impact, then that brings forward a lot of sales, which might be okay if you're looking at home buyers by bringing those forward and releasing a lot of stock. The alternative is if it's just, well, you just hold on, it's grandfathered, so that anyone who is in property or shares or whatever capital gains, and that's one of the things, is it going to only be on property, or is it also going to be on shares? Is it going to be all capital gains? Because that will then change the market. People might not go to property, they might go to shares. So that's another thing they have to wrestle with. But if it's simply from all new acquisitions, then the danger about that is that means that people will hold on to those assets for a long time. So if the government wants it to, impact intergenerational wealth, what's going to happen is those properties will then be passed on to the children. That'll be capital gain. There's no capital gains tax in terms of estate planning at that time, and it'll carry on down the track. So it's actually going to have a reverse effect of releasing that stock in the market. Which way it'll go, that's a lot of conundrum. I'm sure they've done their modelling, but we're going to find out on the 12th of May, and certainly I'll be addressing it from the 13th of May onwards in a few special videos looking at different sectors, and of course my mates in the cryptocurrency. Grant Abbott signing off.